Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
Today we're going to be talking a little bit about something that I think many people wonder about: digital finance and technology.
Today we're going to talk about coming out of retirement.
Today Ryan and I are going to talk about how often you should update your financial plan.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Cole and Logan from Buska Wealth Management and Buska Retirement Solutions. We'll be answering some of your questions about planning for retirement. But if you'd like to see a question answered on a future segment, please feel free to email us at info@retirewithbuska.com. Cole, Logan, thank you so much for joining me today.
Of course.
Today we're going to be talking a little bit about something that I think many people wonder about: digital finance and technology. Cole, we're going to talk to you first. How can our viewers use technology to improve their financial management?
It's an interesting question. I think that obviously, even just in the, almost 18 years that I've been in this industry, technology has evolved dramatically over the course of that time. And, obviously we've done our best to try to keep up with the changes that have happened over the course of that time with offering new services to our clients. The generational vault obviously has been a huge advantage for our clients to be able to keep closer watch over their accounts in one kind of centralized system while also maintaining all of their documents and things like that. But there's so many different ways that you can track your finances now. Most financial companies have an app of their own now that you can download and track your account balances. And they also have, the ability to log in online and all of that. Plus now there's all sorts of different stuff like budgeting apps and things that you can use to keep better watch on your day-to-day finances, kind of figuring out what categories you're spending the most in and then making adjustments as you move along throughout the course of the year. If one portion of the budget is maybe taking up a larger portion of the income than you maybe desire or initially thought it would. So I would say just learning about the technological advances that are out there nowadays. What are the different offerings from the various different companies that you're working with? And if you feel like, your financial professional isn't really giving you the technological advances that you are looking for at this point, then it might be time to explore a new relationship.
Logan, what are the risks and benefits of using digital financial tools?
Yeah, so to start out with the risks, it's, as we know, that there's always going to be those people out there that are trying to take advantage of other people. So with technology now, you just want to be cautious about when you're getting emails Nowadays, you're getting a lot of those text messages, and you just really just want to be cautious with all that stuff. So be aware of just all the technology scams out there. Stay up to date by talking to friends and family, watching the news, talking to your financial services professional, but really just not clicking on something random, which has always been a thing. Just do a little bit more research. So that's on the risk side. As far as the benefit side, it really can help out with, Cole had said earlier, with the budgeting, using technology for that. But I think one thing we see a lot with our clients is they don't know their username and login for their 401k benefits. So I'd really just stress to our clients and viewers out there to really know and log in, so that way you can understand how your money's moving, where it's invested, what's going on, make sure you have your beneficiaries listed and all that. So there's gonna be pros and cons to everything, but with the technology side, as far as tracking your stuff, it's really a huge benefit.
Yeah, I think just to add to that in terms of the risk component, I mean, obviously, you have to be your own best advocate in terms of, like Logan said, not accidentally clicking on a link that you shouldn't, or maybe assuming that an email is coming from a real source when it might be a potential hacker or scammer. And so what I always tell clients is be speculative of everything. I mean, if you're not 100% certain, maybe do your due diligence, reach out to that company or that professional or that person and make sure that that really is a legitimate communication before you go clicking on anything, because obviously cleaning up the damage can be much harder than taking a little bit of time just to make sure before you delve any further, into something that might cause problems for you.
Be safe, not sorry.
Exactly, yes.
So there are a lot of financial scams out there, unfortunately. Cole, you just talked a little bit about this, but specifically, how could people protect themselves from those financial scams?
Well, I think the biggest thing that they can do is really, make sure that they're checking the source of where things are coming from. If you're getting an email, pay attention to the email address that it's coming from. One thing that I've noticed, even because, we get emails all the time trying to get us to click on links and things like that. And one thing that I always make sure to pay attention to is where did it actually come from? If it looks like it's an email from Microsoft, but it's coming from a Gmail email address, probably not really coming from Microsoft, And granted, they're getting better at spoofing some of these things, but you have to just be ultra cautious, if you're getting a text message and it says it's from a certain person or company, maybe, do some research on that phone number it came from. Reach directly out to the company by looking up their phone number on their website and just do your due diligence. You no longer are we able to just trust that a communication coming in is from who they're saying it's from. We really have to take a few extra steps to make sure before we get ourselves into any hot water because we clicked on something wrong or we downloaded something that we shouldn't have, and all of a sudden we're dealing with potential ransomware or whatever it might be in regards to that particular communication. So just take a little bit of time, take a step back, really pay attention to all of the details that are in that email or that text message or that communication, and just be cautious.
And verify. Trust but verify.
Yeah, and I would add to that too is be proactive with it. Mm-hmm. So go out and make sure you have that good cybersecurity protection. Call the credit bureau and freeze your account so someone can't steal your information and open up a credit card under your name. So just take those proactive actions to prevent some of that scams to happen too.
Yeah, and a lot of that stuff doesn't take much time. When I learned about credit freezes, it took me like 10 minutes to go into the credit bureaus and get it taken care of. And now it's just that extra layer of protection. It's peace of mind. And really anything that we can do to provide ourselves more confidence and peace of mind is time well spent from our perspective.
Absolutely. So Logan, we're going to end on what are some of the trends we're seeing in digital finance that our audience should be aware of?
Yeah, so right now, I think the biggest thing that we've seen recently relates to those robo-advisors or bank accounts online where they don't have that standard brick and mortar building you can go to. And with that, a lot of our clients or even viewers are coming in and saying, hey, I found this really high interest rate in this bank account. I'm going to move my money there. What do you think? And that's where I think it's really important to sit down with a financial services professional, because a lot of times when you're getting those higher interest rates, it comes with stipulations or requirements to get that. And that's always the fine print there. So the biggest trends we see is trying different banks or companies trying to attract new deposits coming in. like those online banking, and then the robo-advisors. They're doing the investments for you, so they have lower fees, but is it actually looking at your full picture for your retirement strategies or not? And how are they investing? Where are they investing? So the biggest trends are around that we've seen.
Yeah.
If you have anything to add for that.
Well, and I think the biggest thing is, especially in terms of a lot of those online resources for portfolio management and things like that, I mean, you kind of lack that human touch. I mean, in terms of managing portfolios, sure, that might be all well and good if you trust an algorithm to do that for you. But at the same time, I mean, when you have a specific question or a specific circumstances that you're dealing with in your own personal life, there is value in being able to sit across the table from someone and really hash that out and look at it from all the various different perspectives. And I think that's where, having a robo-advisor or anything along those lines might be disconnected. I mean, you don't have necessarily that ability to build a relationship with a computer per se. And so obviously from our perspective, a lot of our clients really desire that connection, that ability to, work one-on-one with a professional or a team of professionals to make sure that they're doing things that they should be and that they're not missing opportunities.
That's great. Well, thank you both for joining me today to talk about digital technology in the finance space.
Of course.
And thank you all for joining us. We'll be back with more Financially Speaking right after this.
Are you ready to take control of your retirement? If you're 59 and a half or have recently changed jobs, it may be time to consider a 401k rollover. With a rollover, you can consolidate your old retirement accounts into a single investment vehicle. Say goodbye to scattered funds and hello to more diversified options. A rollover gives you the freedom to choose from a wider range of options tailored to your unique financial goals. Don't let your retirement savings gather dust. Reach out to speak to one of our advisors today to explore the benefits of a 401k rollover.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Logan Waller from Buska Retirement Solutions and Buska Wealth Management. Today we're going to talk about coming out of retirement. A perhaps surprising number of retirees end up going back to work, and it's sometimes for reasons other than money. A U.S. News and World Report article titled 8 Benefits of On-Retiring provides some useful perspectives. While many people unretire because of a lack of income, the article explains that even if you have a sizable nest egg, returning to work on a part-time basis may help you push off withdrawals from your retirement accounts, depending on the rules, of course. It's important to be careful about what your choice to unretire could mean for your Social Security, because you don't want to put yourself in a position where you unretire, get a job that's both enjoyable and financially beneficial, only for it all to feel like a fool's errand because in the end, it reduced your Social Security payment. I'll go into more detail on that in a moment. The article also explains that unretiring could provide you with some lasting financial benefits. For example, retiring before you're eligible for Medicare typically means you'll need to find healthcare coverage on your own. And boy, are you going to have some sticker shock once you start shopping around. But if you unretire, you can prioritize finding an employer that provides excellent healthcare coverage. For many retirees, boredom is something they must grapple with, sometimes so much that it leads to them to unretire. But there are also times when the issue runs much deeper than common boredom. If you retire without a spouse or partner, or you don't have a reliable circle of friends, social isolation is a significant danger. Unretiring could surround you with new people who have similar interests and who then become friends outside of the office. Even if you don't build significant friendships with your coworkers, you may still find the value in conversations and interactions that occur throughout the workday. Another possible upside that comes with unretiring is the physical and emotional boost you'll get by helping other people. If you unretire and take on a new role with service focus, like working with people who have special needs or helping at a food shelter, you'll not only enjoy additional income, but you'll also be serving your community in a way that provides you with a genuine sense of accomplishment. Regardless of what industry you made your living in, there are likely people out there who would benefit greatly from your experience and skills. Put what you learned during your career to work for others. Another possible benefit of unretiring is the opportunity to try some things that you've long been curious about. During our working lives, we often don't have as much time as we'd like to support causes and organizations we care about. And we don't always have ample time to pursue our own interests and curiosities while we're busily growing our careers. But if you choose to unretire and pursue a job outside of your previous field, it may be the perfect time to follow some of your interests. If you've always been fascinated with history, why not a part-time job at a local museum? If you love animals, why not explore opportunities for things like dog walking or pet sitting? If you like to meet new people, why not try driving for a rideshare app, make airport pickups, and encounter folks from all over the world? Unless your unretirement is due exclusively to financial considerations, you can prioritize your happiness when searching for an unretirement opportunity. Before I sign off, I want to briefly go back to working while collecting Social Security. The rules are a little bit complicated. The limit for how much you can earn from a job while receiving benefits varies depending on your age. In 2025, the limit for how much you can earn from working is $23,400 if you are under full retirement age. For every $2 you earn above that limit, the Social Security Administration will deduct $1 from your Social Security benefits. Now, if you've reached full retirement age, it's a different story. The limit for earnings in 2025 is $62,160. For every $3 you earn above that limit, you'll lose $1 from your benefits. If you plan to work part-time, it's likely that the money you earn won't have much effect on your benefits, but you may want to take a look at those limits before you take on paid work. Note that the Social Security Administration does not count pensions, annuities, investment income, interests, or veteran benefits when deducting other sources of income from your Social Security benefits. That's all the time I have for this segment. If you're considering coming out of retirement and want to see how it could impact your financial strategy, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you ready to make your retirement planning more stress-free? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make securing your future easier. By creating a comprehensive retirement plan that incorporates retirement income solutions, investment management, estate planning, tax strategies, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
You've worked hard to save money for retirement, but wouldn't you rather thrive and not just survive your golden years? My newly released book, Golden Rules of Finance for the Golden Years, offers key tips for managing your retirement money and ensuring you have a more complete plan to make your retirement dream a reality. Call 715-355-4445 or visit buskabook.com to request your complimentary copy today.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Sue Buska from Buska Retirement Solutions, and joining me today is Ryan Connor. Today, Ryan and I are going to talk about how often you should update your financial plan.
That's right. A Kiplinger article titled "The 5 Times When You Should Review Your Financial Plan" offers some useful information. It may seem like a financial plan is a one and done sort of thing, but things can change. And revisiting that plan helps ensure that it continues to align with your goals, even as your desires and circumstances change.
So, should we wait for a major life event to take place before you review your plan, Ryan?
No. The first thing the article recommends is reviewing your plan when things are calm.
Right. And it's easier to make good decisions when you're clear and calm.
Exactly. The Kiplinger article recommends being proactive. Now, there's a great line in the article. The best time to plan is always yesterday. The second best time is today.
Now that's great, and second best is good. I don't want anyone listening to think that maybe they don't have a plan already. I mean that it's too late for them to make one.
Absolutely. It's better to have a plan already, but it's never too late to make one. If you have a plan in place and there's a big change on the horizon, that's a really good time to review your plan before that change goes through.
And what kind of changes should prompt folks to review their financial plans, Ryan?
So according to the article, you should review your plan when you have lots of different goals to prioritize. If you're saving for your kids' college, planning to get an advanced degree, putting money in a travel budget, thinking of moving, or hoping to retire early, those are all important goals, and you may not know how to achieve them all at once.
So putting them in order and deciding which one to work towards first can help you achieve all those things.
That's right. Sitting down to review your goals can help you figure out which is the most important, and things may fall into place nicely after that.
So when you decide which goal is most important and start working towards it, you can see the progress you're making, and you might start to feel more confident about achieving those other goals.
Yeah, when you see the funds adding up in your kid's college fund, you can start to imagine crossing it off your list and then starting on the next goal.
Now, isn't that what I said?
Yes, but I wanted to say it too, albeit in a different way.
Now, what about big changes or purchases? Should you review your financial plan then?
Yes. According to the article, if you get a bump in pay from your employer, that's also a good time to review your plan. If you sell a house, it's another very good reason to review your financial plan. When your family grows or you start a business, again, those are reasons to review the plan. Now, of course, the article once again stresses that you should be proactive and look at your plan before you start a business, sell a house, or whatever change it may be. It goes on to say that you should circle back and review it again after the fact.
Now, wait, so you have to review your financial plan before and after a big change or big ticket purchase?
Well, let's take a home sale, for example. You can proactively review your plan before you sell the home, during which time you may estimate the amount it will sell for. Then, after you sell it, you can update your plan with accurate numbers because you'll know exactly how much you got for the house.
I see. So the first review is about being proactive, and then the second review is for accuracy.
Exactly.
Now, that seems like a lot.
It does, but financial success often stems from staying on top of things, and that's really what this is all about.
Okay, but I'm sure some of our viewers are feeling overwhelmed. What would you tell them?
Well, I'd remind them that they don't have to go through any of this alone. A financial services professional can do these reviews with them.
And that makes sense, Ryan. I am sure folks in the audience are relaxing already. Many hands make light work, as they say. So what other times would you need to review your plan?
So next, the Kiplinger article recommends reviewing your plan when you're not sure what to do next. Uncertainty arises sometimes, and that uncertainty makes us anxious. Taking a look at your plan can help you feel grounded, and it can remind you that you have a solid strategy.
Now, we see this a lot, don't we? Now, when the markets are volatile or the news is full of doom and gloom about the economy, people get worried. They feel like they need to do something, anything, because doing something makes you feel proactive.
And that's why proactive planning ahead of time is so important. When uncertainty pops up, you'll have already done the proactive thing.
And that's the thing you should stick to, right? Because decisions in times of market volatility are often the wrong ones.
Yeah, and you hit the nail on the head there, Sue. Making reactionary decisions based on short-term events can derail a long-term plan. Instead of making decisions out of fear, take a look at your plan and remember why you should stick with it in the first place.
Well, what's the last thing on the list?
So the last thing the article recommends is reviewing your plan at least once a year. Things can go out of date quickly, so it makes sense to look over your plan on at least an annual basis.
And it's like you said earlier, financial success often comes down to staying on top of things.
Exactly. Plus, every change that happens in your life has the potential to mess with your plan.
Right.
So it's crucial to make sure that your plan is updated to reflect those changes. Your priorities may have shifted since the last time you looked at your plan, and it may be a good idea to change your plan so that it is in line with those new priorities.
And you want to make sure that the data is accurate, like we talked about before.
Exactly.
So to recap, we should review your financial plan when you have a lot of goals to prioritize, when you make a big change or transaction, when you're not sure what to do next, and once per year.
Exactly.
So we've got some time left. What should we talk about during these last few minutes?
The Kiplinger article we've been discussing is linked to another one titled 10 Money Mistakes Millennials Should Avoid. Number 10's a shocker.
Ooh, that sounds interesting. Now, we may not get through that entire list with the time we have left, but let's go over a few.
Here's a big one. Failing to think about the impact student loans will have.
Ooh, that is a good one. You should think about how much you'll be able to earn once you finish your degree. Will it be enough to help you pay down that loan? If not, the loan might not be worth it, and a less expensive program might be a better choice.
Right. And if you have a large student loan payments to make every month, it can make it more difficult to save, and that leads to the next item on the list, waiting to start saving.
Now that's another great point. Saving money takes time, and your money needs time to compound and grow. The longer you wait to save, the more you rob yourself of that.
Exactly. Plus, you may think you can wait to start saving, but you can't predict when you'll have an unexpected expense. Find a way to start saving even if you don't think you have room, so if something does pop up, you have the ability to cover it.
I feel like we've discussed this on a previous episode, Ryan.
We probably did, but I don't mind being a broken record on this topic. It is really important. Anyway, I think we have time to go over one or two more of these millennial money mistakes. The next one is ignoring the consequences of an expensive wedding.
Oh, great point. In my opinion, you don't want to start married life paying off a debt.
Especially if you already have other debts.
Right, and you have your whole life ahead of you. Plan for that, not just for your big day. Let's do one more quick one.
Another mistake is too many credit cards.
Oh, that's also a good one. That can get out of hand quickly. And with that, we're out of time. Viewers, if you want to review your financial plan, contact our office today at retirewithbuska.com or call 715-355-4445. And with that, we're out of time. We'll be right back with more Financially Speaking after this.
Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. But if you're like many savers, you probably don't know the total taxes that you could end up paying. At Buska Retirement Solutions, we believe information is critical to making informed decisions. So I want to share with you a resource that can help quickly evaluate your potential taxes in retirement. Visit BuskaRetirementTaxBill.com to generate your personalized report. And once you've seen your retirement tax bill, let's talk, because there may be ways to improve those numbers.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.